Iron Financial. In a market like this one, weakness isn't just a problem, it's a liability. We're here to do one thing: stress test companies, hammer on their structural integrity, and help you forge a stronger, more resilient portfolio. Today, we're putting Netflix on the anvil. They've just dropped their Q4 2025 results, and frankly, they've made a move that's either going to define the next decade of media or absolutely shatter their balance sheet. Let's get to work.
Okay, let's just cut right to it. The elephant in the room, the thing everyone is talking about, is this Warner Bros. Acquisition. This is a colossal $59 billion plus move to consolidate power. Make no mistake, what Netflix is trying to do here is build a media fortress and empire with a moat so wide and so deep that no competitor can even think about crossing it. They're literally buying a century of iconic intellectual property. But is it a fortress or a prison? I mean, they're shackling themselves to an absolutely enormous amount of debt to pull this off. So this isn't just some clever strategic move. It's an all-in, high-stakes gamble. For any investor, the question you have to ask is simple. Are they buying impenetrable strength, or are they buying a catastrophic risk that could bring the whole structure crashing down?
So here's our blueprint for the analysis. We're going to start at the bottom with the foundation, the high-level numbers that everything else rests on. Then we're going to pop the hood and inspect the core streaming engine. After that, we'll test the new growth pillars they're trying to build. And then we get to the main event, a really deep dive into the Warner Bros. Gamble. Finally, we're going to put the entire newly combined structure through a rigorous stress test and deliver our final verdict. Let's get into it.
All right, Section 1, the billion-dollar blueprint. Before we can start looking for cracks in the armor, we have to understand the sheer scale of this operation. These are the top-line numbers, the ones that define the company's financial bedrock. So pay close attention, because every single thing we're going to talk about today is built on top of this foundation.
Let's start with raw scale. $45.2 billion in revenue for the full year 2025. I mean, let's be clear, this is not a startup, this is a financial juggernaut. This number represents the solid ground they are building on. It's the kind of raw financial power that allows them to even contemplate a move as massive as the Warner Bros. Acquisition. This right here is the bedrock.
Now look at the velocity. It's not just big, it's getting bigger, and it's getting bigger fast. 16% year-over-year revenue growth. At this kind of scale, that number is formidable. It tells you the core engine isn't just idling, it's accelerating hard. This is the momentum that the bulls are betting on, and you can see why.
Okay, fine. Revenue is one thing, but profit is really what matters at the end of the day. And you have to give them credit here. This machine is incredibly efficient. A 29.5% full-year operating margin, and that's up from 26.7% just the year before. So the crucial point here is that they aren't just growing the top line by burning through cash. They are systematically building a powerfully profitable enterprise. Every dollar of revenue they bring in is contributing more and more to the bottom line. This is exactly the kind of operational leverage that serious investors want to see.
Okay, Section 2, examining the core engine. We've seen the impressive exterior. Now we're going inside to really inspect the machinery. Is the streaming business, the absolute heart of this company, as strong as those headline numbers suggest? Or are there some signs of wear and tear just below the surface? Let's find out.
Just look at this progression. This chart tells a story of acceleration. Yeah, there was a little dip in Q1, but after that, they picked up steam every single quarter of 2025, ending the year with a powerful 17.6% growth. That's a strong trend line. It demonstrates that they can manage pricing, membership, and advertising all at once to drive consistent, accelerating growth. To me, that's the sign of a very well-oiled machine. But hold on a second. A well-oiled machine that's telegraphing a slowdown? Look at the numbers they're guiding to for the future. The full-year forecast for 2026 is 12 to 14% growth. That is a material deceleration from the 16% they just put up. And even their own Q1 forecast is a step down. So yeah, the rearview mirror looks fantastic, but the future they're actually pointing to is one of slowing growth. This might be the very first hairline crack in the foundation. It begs the question, why on earth would you make the biggest acquisition in your history right when your core engine is starting to lose steam?
This right here, this is the lifeblood. $9.5 billion in free cash flow. This is the actual cash the business generates after all expenses and all investments are paid for. It's what gives them the power to make these huge strategic moves, to repurchase shares, and now to fund a massive acquisition. And it's up substantially from $6.9 billion in 2024. This isn't just a number on a page, it's pure financial firepower. It is impressive firepower, I'll grant you that, but a huge portion of that firepower is about to be redirected. They're taking on a massive bridge loan to buy Warner Bros. That means new, heavy, non-negotiable interest payments. So the real question becomes, how much of this incredible cash flow will now be dedicated to simply servicing debt instead of reinvesting for growth or returning it to shareholders? That huge pile of cash is about to get a very large new claim on it.
All right, section 3. Look, a strong core is absolutely essential, but for a structure to really last, it needs multiple points of support. So here, we're examining the new pillars Netflix is trying to build out: advertising and gaming. The big question is, are these going to be truly load-bearing structures that can support future growth? Or are they just expensive, decorative scaffolding that looks good but can't carry any real weight?
I mean, just look at this chart. This is explosive. Ad revenue grew more than 2.5 times in 2025 alone, hitting over $1.5 billion. And their ambition is crystal clear. They're forecasting it to roughly double again in 2026 to around $3 billion. They are not just dipping their toes in the water here. They are firing up a powerful second engine for the entire business. Explosive growth, yes, but let's be real. It's off a tiny base. $3 billion is still less than 6% of their total projected revenue for 2026. So is this a real sustainable growth pillar, or is this just the easy gains you get in the early stages when you're just finding your footing? Because doubling gets a lot harder every single year. I want to see if this pillar can truly carry weight when it's no longer the new, exciting thing. Is this real, or is it just hype?
This quote from co-CEO Ted Sarandos is absolutely crucial because it shows their strategic intent. They're not just tacking on little features here and there. They are consciously and deliberately trying to build out entirely new content categories. This isn't about just tweaking the streaming service anymore. It's about transforming the company into a multifaceted entertainment platform. Right, but it also shows a potential lack of focus. Every single dollar and every minute of management attention that's spent on video podcasts or some cloud gaming idea is a dollar and a minute that is not spent on improving the core film and TV business, the business that actually pays all the bills. You know, diversification is smart, but diversification, as they say, is a very real danger.
And look, these aren't just ideas on a whiteboard. They're active ventures happening right now. They're pushing into live sports globally. They're forging major partnerships for podcasts with huge names, rolling out cloud gaming to millions of TVs, and securing massive licensing deals for blockbuster films. Each one of these is a strategic reinforcement, designed to buttress the core business and open up brand new revenue streams, or they're expensive distractions. Live events are incredibly costly and complex. Podcasts are a brutally crowded market. Gaming is notoriously difficult and expensive to break into, and increased licensing fees just mean higher content costs. So, are these ventures truly reinforcing the structure, or are they just adding a ton of complexity and cost without any guaranteed return on that investment? Each one of these is a gamble in its own right.
And now for the main event. Section 4. The Warner Bros. Acquisition. This is, without a doubt, the single biggest bet in the company's entire history, and a move of this magnitude requires a full structural analysis. From our perspective, this is a masterstroke, a decisive move to achieve total market domination. And from my perspective, it's a potentially fatal gamble that could cripple this company with debt for a decade or more. Let's really break down the risks here.
So, first things first, how in the world are they paying for this? With debt. A lot of debt. Specifically, they've secured a massive senior unsecured bridge facility. In plain English, that's just a huge short-term loan designed to get the deal done quickly. And as of January 19th, their commitment on this facility was over $42 billion. The plan, of course, is to replace this bridge loan with more permanent bonds and cash on hand down the road. But the crucial point is the sheer mind-boggling size of the debt. They ended 2025 with about $14.5 billion in gross debt. This deal is going to multiply that figure several times over. They are fundamentally altering the company's financial structure from a position of incredible strength to one of heavy leverage. Every single decision from here on out will be made with this mountain of debt looming in the background.
So why on earth take on that kind of risk? Well, here is their official argument, their architectural plan for this new media empire. First, you acquire a century's worth of valuable intellectual property and a vast content library. Second, you add HBO Max to offer more flexible subscription tiers and bundles. Third, you absorb Warner's massive global production capacity. And fourth, you frame the whole thing as a pro-industry move that creates jobs. This is their case for why this deal is not just big, but smart. It's a vertically integrated plan for total domination.
But this slide really shows the other side of that coin. For every single pro, there's a significant structural con. More choice for users could eventually just mean higher prices as competition is wiped out. Strengthening their market position brings with it massive regulatory scrutiny from governments around the world.
all this talk of job creation, conveniently ignores the inevitable and painful process of integration, which always means layoffs. And accelerating their strategy comes with the colossal risk of that massive new debt load we just talked about. This is not a simple win. It's a high-wire act with absolutely no safety net.
Okay, Section 5, the final stress test. A structure is only as strong as its ability to withstand real pressure. So right now, we're going to apply that pressure to the weak points: user engagement, the competitive landscape, and Wall Street's reaction to all of this. We need to see if this newly designed company can actually hold up under real-world stress.
So let's start with engagement. Now, the bull case here is the growth they're seeing in their own content. Viewing of Netflix's branded originals was up a strong 9% in the second half of 2025. That shows they can create content that really resonates and builds a loyal audience. They're successfully shifting viewing habits to their own IP, which is an absolutely critical long-term goal. But you have to look at the bigger picture. Overall engagement, the total hours watched across the entire platform, was only up 2%. That's anemic. And what's worse, viewing of licensed content, the stuff they buy from other studios, is actually declining. So while they're definitely having success with their own shows, the overall user habit seems to be weakening. A 2% growth in your single most important metric is a huge warning sign. It suggests the core user base might be reaching a saturation point.
And this is Ted Sarandos himself, their own co-CEO, admitting the brutal reality of the competitive battlefield. They are not just fighting other streamers anymore. They are in a multi-front war against the biggest, richest companies in the world. Exactly. He's basically saying the lines have completely blurred. YouTube is TV now. Amazon is TV. He even says Instagram is coming next. The competition isn't just Disney Plus or HBO Max, which, ironically, they're trying to buy. It's every single app on your phone and your smart TV. This intense, never-ending competition puts a very real ceiling on their pricing power and their long-term growth potential. They're fighting for every single minute of a consumer's attention, and that fight is only getting harder.
And here's a perfect example of how the market reacts to any sign of trouble. Just look at this chart. Back in Q3 2025, they had a negative earnings per share surprise. Basically, they missed Wall Street's expectations. And what was the result? The stock got punished hard. This shows you just how nervous the market is. The stock has been priced for absolute perfection for years. And now, any crack in the armor, any small stumble, is met with a swift and severe penalty. With all the added complexity and debt from the Warner deal, their margin for error is now effectively zero. All right, we've run the numbers. We've examined the engine. We've analyzed the gamble, and we've applied the stress test. It's time for the final verdict from Iron Financial. Is this company a generational buying opportunity? A chance to get in on the ground floor of a new media empire? Or is it a carefully disguised trap for unwary investors?
Let's summarize the bull case one more time. The foundation is incredibly strong. You have a dominant $45 billion revenue base that's still growing at 16%. The profitability engine is powerful and efficient, with operating margins expanding to nearly 30%. They are successfully building a new, truly load-bearing pillar with their advertising business, which is growing exponentially. The company generates a massive amount of free cash flow, giving it immense strategic power. And the Warner Bros. Deal, for all its risk, is a bold strategic masterstroke to acquire a century of invaluable IP and solidify their market leadership for the next generation. This is a case for unparalleled, enduring strength.
And now, the bear case. Let's recap the critical risks, the cracks in this foundation. The first crack, their own forecast shows that revenue growth is clearly decelerating. The second, overall engagement growth is dangerously low at just 2%, suggesting user saturation is a real problem. The third, and by far the largest crack, the colossal debt and immense integration risk from the Warner Bros. Deal, which could handicap this company for years to come. Fourth, they face a brutal, multi-front war for attention against the largest and richest companies on the planet. And finally, they're walking a tightrope with a market that has shown it will punish any and every misstep. These are not minor issues. These are potential structural failures waiting to happen. So here it is, the Iron Financial verdict. Netflix is undertaking a calculated, high-stakes gamble. The objective is crystal clear: to forge an unbreakable media monolith, an empire that can withstand any competitive assault for the next decade. The acquisition of Warner Bros. Is the key piece in this entire construction. The risks that we've outlined today are severe and they are very real. The debt load is immense and the integration process will be perilous. However, the potential reward is absolute market dominance for a generation. Therefore, we see this as an opportunity. But let's be perfectly clear, this is not an investment for the faint of heart. The potential for volatility is extreme. This is a bet on ambition, a bet on execution, and a bet on building something that lasts. Proceed with caution. That's our analysis. Stay strong.